Welcome to the FreightWaves monthly market update in partnership with Convoy. We're excited to have you here. So today, unfortunately, Marianne is out sick. We hope that she has a speedy recovery. So Ibrahiim, I am going to get us started. How are you doing today?
I feel pretty good.
How about so? Well, I feel good. It's been a busy day here at FreightWaves, and good to have you back in Chattanooga for another monthly webinar.
Yeah, let's get started.
I agree. So today we're going to talk about a lot of stuff. We do this monthly for those that haven't joined us. This is actually our biggest attendance so far. So we've got record attendance on this webinar. We're getting to the point, we're getting close to 1,000 people attend these things. It's a ton of interest in what's happening in the market, and we're excited to dive into what the freight market is telling us. Want to thank our friends at Convoy for sponsoring this and bringing great content. They're doing some interesting things around just changing the way freight brokerage is managed with their trailer asset pool and guaranteed detention and really everything that's taking place. I'm really excited to have them as a partner on this and certainly excited about joining you today to talk about freight. We have a special guest that actually was a late addition. Henry Byers is our international freight expert, has spent time both in domestic truckload at Coyote, has also spent time on international shipping and freight forwarding with Steam Logistics. And he has been diving into international cross-border and freight forwarding data to understand how the ports and the international trade and tariffs are impacting the freight market. So we're going to have him on in a bit. Real quick, I'm Craig Fuller. I'm the CEO and founder of FreightWaves, and with me is Ibrahiim Bayaan, the Chief Economist of FreightWaves. So welcome, Ibrahiim. So a little bit about who we are is we're building and continue to build the largest ecosystem dedicated to understanding the freight markets. We combine data and tribal knowledge to help interpret, analyze, react, forecast what is actually taking place around freight and logistics and supply chains. Our team is made up of about 25 full-time reporters, and actually by the end of the year, it should be around 40. So we're adding a bunch of new reporters with very specific beats around major content. We're the largest news site. We're getting about 50% of the traffic related to freight and logistics news globally. So we're really excited about what's happening there. Our traffic's going up about 50 to 60% per month. So it's really a lot's happening. But really excited to dive into this. Again, we talk a lot about the fact that we use data and we inform it with tribal knowledge. Tribal knowledge is just experience, the fact that you've been there, and we have a lot of people in-house that have been there and understand what's actually taking place. On today's agenda, we're going to dive into the GDP results, a lot of this to discuss on GDP. We're going to dive in and talk about the recent freight demand, just volume, and understand what's happening from a volume perspective. I want to hear your perspective, Ibrahiim, on trade war escalation and what you think that's actually happening. You and I have talked oftenly, even on this call, about whether or not trade tariffs are going to impact the economy and what's happening. I'd love to hear if you have an updated point of view. I certainly have one. And then trends in freight capacity and pricing, and then just talk a little bit about regional freight patterns. And then we're going to close it off. This is, again, a very late addition to the show. Related to maritime and international forwarding with Henry Byers. So excited to have Henry on today. Just in terms of getting into the summary of what we're seeing today, Ibrahiim, you want to take us and really go into it?
Yeah, I mean, I think when you look at a lot of the data, it's pretty clear that at least the freight economy has gotten off to a very poor start in 2019. Manufacturing's not doing well. Some positive signs starting to emerge from the housing and construction sector. But I think overall, there's been some recent developments on trade policy that have begun to threaten the outlook. I think at this time last month, I was thinking that a lot of the early weakness was temporary, should lead to stronger growth going forward. But with tariffs, that adds an additional layer of complication in there, and rates continuing to come down in the trucking industry.
So really, my summary is really related to freight. So Ibrahiim has an economist point of view, and I give him a hard time because economists have to have a lot of data to confirm you're in a recession. Usually they confirm it after you're out of it. Same with an expansion. But ours is really, or my perspective, tends to be freight driven. And if you look at all modes of traffic, there is signals of a dramatic slowdown. Now, we're in the early stages of that. So this is This is not, there's a lot of differing views of this, but it's been slowing, but really dramatically of late. And we're going to talk about why we think that's the case. I think the other thing that I've tried to do over the last couple of weeks, not just me, but really the broader team, is have a lot of conversation with executives, participants, really across the whole market. And these include factoring companies, insurance companies, truck stops, participants in freight of all modes. And I think everyone is seeing much of the same thing. The only part that I think is actually somewhat defensible, which is interesting, is some of the flatbed operators that operate in long-term contracts are actually doing quite well in this market. I think a lot of it has to do with the fact that the overall, they've got these agreements and projects locked in on long-term agreements, and they're not having the same issues around driver availability that they perhaps did last year. And so it's really interesting. These are some quotes I just took out from a number of parties. I didn't mention specific parties as to who these were related to, but I had a factoring company tell me that their rates are down 23%, but the amount of freight that they're actually handling has declined by double digits. So not only are rates down, but more importantly, the volume is actually down. And then, of course, I had a parcel company tell me it felt like the end of April. I thought this was interesting. It was I've heard a lot on the truckload side. One of the things that I thought was really interesting was that parcel is down. And you're a parcel, you at one point in your life were a parcel guy.
No, absolutely. And I mean, it is fairly surprising because, most of what happens in parcel has ties to e-commerce. And e-commerce, while a lot of other areas in the economy have slowed down, e-commerce really hasn't. I mean, it's been doing well. Most of the signs are still pretty positive. And so overall parcel market, especially the B2C component of parcel markets, I think still have pretty solid fundamentals on behind it. Now, I mean, the B2B side, the sort of commercial transactions that occur probably face some of the same kind of headwinds that trucking has experienced during the early parts of the year.
Yeah, that was interesting. I asked if it was e-commerce to this particular executive, and he said actually it was a broader commercial business. Yeah. That e-commerce wasn't really what was driving the volumes down, but a lot of it was just related to their broader business. I had 3PLs, a very large 3PL, a multi-billion-dollar 3PL. Said that basically, I think the quote right here was 30% more volume for the same revenue. Just had to do a lot more. Now, a lot of that's related to rates and just the fallout of rates, but it certainly suggested something. We had a 4PL tell us that that shippers are forcing freight into the spot market. How times have changed. A year ago, they didn't want to be in the spot market. This year, they want to be in the spot market, and they want to be in the spot market to take advantage of those lower rates. I had a truck stop chain, a large truck stop chain, talk about just gallons that are down across the board, and even that carriers are laying trucks over. And again, we could spend a lot of time on this. I think this, I keep looking for signs that maybe, this isn't just confirmation bias. We're seeing data that we sort of believe it. What I'm trying to understand, is there anything of real signs of strength in the market? And I'm just not seeing anything that disagrees with the sentiment. I did see, though, today that Target had its best earnings in a while, if not ever. And what do you think is just retail, right?
Well, yeah, and I was going to say that when you talk to carriers, a lot of them have these kind of quotes that you described, but I think the shipper sentiment isn't exactly the same, right? Like there were a lot of misses during earnings season from major shippers, but there weren't a whole lot of outright declines. Like a lot of people missed what their earnings targets were, what their volume targets were. But like Walmart had growth, Target reported growth, and so you don't see the same sort of this idea that volumes are just down. Is
it more of a function of the retail sector, which tends to be what I'm assuming that's what you're referring to, right?
Well, I mean, it's broader than retail, but yeah, I mean, a lot of that does help. Like
retail seems really strong. I mean, consumer spending is
certainly compared to other areas of the economy. I would say retail is performing a bit better than say what we're seeing in manufacturing.
So one of the things I was on a webinar earlier this morning, and we were talking to, it was a Wall Street firm, and we were talking about the fact that what may be happening with retail, particularly e-commerce retail, doing really well, is that perhaps some of these big box retailers, ones that are even not boxes, but e-commerce retailers, are starting to build out their own proprietary networks, which is taking some of that for-hire freight off of the road. And that may be something that's showing up in the data as well.
Well, yeah, and I actually think we talked about this a little bit during the Q&A period of the last time that we gave this webinar, because we were commenting on how Amazon did that sort of thing, where they decided they wanted to move their own freight instead of going out to the higher side of things. And that's partially what happens when you get burned by transportation costs in any given year. Like in 2018, a lot of these shippers, they got hit very hard by higher rates. And when that happens, it basically makes them reevaluate everything. Like in the long run, they have a chance to figure out exactly how they want to do things. And so things like expanding their own private fleets becomes something that's now on the table, whereas in the past it might not have been. And you're right, like what that does is it takes it out of the poor hire market, and put it into the private market. And so it, for a lot of people, it looks like the volume just disappeared.
And in Amazon's case, it's not, from my understanding, of course, a lot about Amazon that it just isn't public. But Amazon isn't actually creating, they're not hiring drivers. They're taking owner-operator capacity and creating essentially a virtual fleet, right?
Yep.
So it's going to be interesting to watch. But you've got some stuff talking about the economy.
Yeah, just to get started on how the economy is doing, I have here GDP results. Here, the blue bars, that's the quarter-over-quarter growth. The black line is just the year-over-year growth in the economy. And from a GDP standpoint, things actually look very good. Like there was a revision to GDP this morning, showed that the GDP grew at 3.1% pace in the first quarter of the year. That was way higher than what I was expecting. Like I think leading into the GDP release, I was thinking more along the lines of 2.5%. Also very surprising to anybody that was in the freight markets during the first quarter, because I think most would have described the first quarter freight market as being fairly soft, and 3.1% is very strong.
Volumes were actually decent, right? Volumes were comparable to 2018, but certainly when there's more capacity, it didn't feel that way.
Sure. And so, I kind of took this opportunity to give a little bit of insight as to how to view GDP and why this kind of disconnect can exist sometimes. It's important to remember that GDP covers everything that goes on in the economy. Like it's the broadest measure of economic activity that we have. And the freight economy really just focuses on the good side of it. And so, for example, like there's a couple of issues that in using GDP as like a solid metric for how you think like the freight environment is behaving. You'd be surprised how many people just kind of latch onto the GDP number and say like, this is how the economy is doing for us. And I think, you make a lot of mistakes when you just jump in and say like, look, GDP is 3.1%. So we had like a 3.1% tailwind, helping to boost performance. The first thing to remember is that the U.S. economy is a service-based economy, right? 20% of the U.S. economy is just financial services alone. Like that's just banking.
Just money flow.
Exactly. And there's not a lot of freight connected to that sort of activity.
And then healthcare is too, right?
Exactly.
Healthcare and education.
Healthcare, leisure, education, financial services, like this makes up more than half of the economy. And if you just look at the private economy, it makes up about 2/3 of all the private activity that goes on. It's just services, right? And so when you're looking at like the GDP number, just keep in mind that 2/3 of it is service activity, and it may not have anything to do with how freight is actually behaving. And in fact, that was the case during the first quarter. Most of the areas that were growing were service areas of the economy. Consumption on services, investment on research and development, right? So those are the kinds of things that are moving and propelling growth, while things like retail spending and investment spending on equipment and structures, they either declined or they were flat, right?
So a freight recession could take place while the broader economy is still expanding.
No, absolutely. And in fact, if you look at the last freight recession that we had in 2015, 2016, right, most of the things that were tied to goods went down. The economy did okay. 2016 wasn't a strong year of growth. Like the economy grew about like 1.6% 2016, but it was still growing. So that's one thing. It's just like it's a service-based economy. Keep that in mind. The U.S. economy is a service economy. The second thing is, when you look at GDP, it's gross domestic product. That is to say that like they only care about the things that are produced in the U.S. economy, so within U.S. borders. And so what that means is like anytime you consume something that gets imported from the rest of the world, they basically just they don't count it. So they'll take all the consumption spending that occurs, then they'll subtract out the part of it that was imported from the rest of the world, right? Because it's not domestic. It's not domestically produced. But from a freight perspective, you don't care whether or not it's domestically produced or not. You care whether or not it's flowing through the economy. So something that gets imported from China that comes into the U.S. and then moves through the rest of the U.S. to the end consumer, that drives freight activity.
And it's not GDP, right?
It's taken out of the GDP.
Taken out of GDP.
Exactly. Yep. It's taken out of the GDP. And so if you have, say, like a decline in imports, that actually helps support GDP growth, but it's not good for freight activity. And then the last thing is the inventory cycle. Like when they calculate GDP, they say like, if you build inventories, that's good for production because it's production that occurred. And whether or not it actually ended up in like an end consumer's hand or not, it's still production. So it adds to GDP. But from a freight perspective, adding to inventories might be a good thing. It might also be a bad thing. Like what you really want is goods flowing through the economy. You want inventory turnover. You don't necessarily need things that kind of go into inventory, sit in inventory, and don't move. And so it's kind of important to just take a look at the inventory cycle a little bit separate from like what the rest of the economy is doing. So like inventories built up during a particular quarter. Did they build up because sales were slow, or did they build up because businesses were anticipating high sales in the future? Like these have very different implications for freight. And so just as a sort of like a pro tip for guys that analyze this type of thing. Normally, when I get the GDP results, like the first thing that I do is I strip out all the service components, and then the second thing is I won't subtract out the imports, and then I'll take out inventories altogether, and I'll kind of analyze those separately. And when you do that, like if you took a look at like the U.S. economy and how those components grew once you stripped out services, once you left the imports in there. The economy grew at like a 0.7% pace of growth.
Are you telling me there's going to be an index soon that you're going to create based on this?
Yeah, sure.
Yeah, all right. So here, inside of Sonar, we're going to have the new Ibrahiim freight activity index.
Yeah, absolutely. Right? And people that are around freight, they do these kinds of things all the time. Like they'll strip out different components because they think, they don't tie. Like a lot of people like private final demand instead of GDP, which is just stripping out certain components. But the best thing to do is just focus on the goods instead of the services. Keep the imports in there instead of subtracting them out, and then just take the inventory cycle out and analyze it by yourself.
All right. So deliverable by next call, we'll get this.
Easy. So looking at the things that actually drive freight activity, and I've said this a bunch of times on these webinars. Like normally when I think about freight, it's manufacturing, it's housing, it's retail and wholesale. There's whatever's going on in inventories and international trade, and then if you're involved in that side of it, also agriculture. Right? So those are going to be the things that drive freight activity in the economy. And when you look at the performance so far in 2019, it hasn't been good, right? So like most of the data coming in from these different sectors have been fairly poor. So here I have industrial production, which is the white line, and then manufacturing industrial production, which is the green line, both of them trending down pretty significantly over the past several months. And in fact, if you look at manufacturing production, it's actually negative year over year. For the first time since like the end of 2016 as you're emerging from the last freight recession. So out of all the different drivers of freight demand, I usually put the most weight on what's going on with manufacturing activity because manufacturing then flows into wholesale, then flows into retail or goes into exports. And so it hasn't been good on the manufacturing front at all. And I think this is contributing to why things felt fairly soft during the first quarter of the year. And you're seeing just downward movements in freight volume. In particular, within manufacturing, the auto sector has been doing pretty poorly. So for those of you that are out there that do like auto trailer kind of work, like moving cars around, 2018 was a very strong year for auto production, and it's really reversed itself very quickly. Like it went from over 7, close to 8% growth year over year to negative 4.5% growth in the matter of a couple of months.
I talked to a guy who's an expediter, and Expedite's huge in auto.
Yeah.
He said that Expedite's down by 70% because auto they're not producing the level of automobile.
Now, I mean, from a demand standpoint, like the U.S. really doesn't. We're not on a growth path of buying more cars anymore. Like auto purchases have kind of leveled off.
So you've seen peak auto probably.
Yeah, at least domestically, and a lot of what drives the growth is exports to the rest of the world. Like it's these emerging middle classes that are coming up in like these Asian countries. As they come up on the world stage, they import autos.
So when you're fighting a trade war, it's not healthy for auto sales.
No, absolutely, it's not good at all.
People are going to be buying those German auto ports and the Japanese.
Yeah, I mean, a big part of the story is just like the global economy slowed down a lot. That stripped a lot of the demand for autos out from under it, and you're starting to see these big declines. Switching gears a little bit to take a look at retail. I always like to say that like the movements in the labor market help form the foundation for retail activity. So I pay pretty close attention to what's going on in the labor market, and things generally look very positive as far as that's concerned. a couple of months ago, there was a surprise low number in terms of the number of jobs that was added back in February. But since then, the pace of hiring has picked up quite a bit. It looks very solid. And also, the pace of wage growth is very strong. So I think income supports are definitely there for the U.S. consumer.
And do you think we'll see that? I mean, do you think even if the freight market goes through what you would call a recession, which would be like to call it, but do you think that that overall employment picture will stay strong?
The employment picture will probably be okay. Because when you look at where the jobs are coming from, just like the economy overall, it's all service dominated. Like, for example, like there's maybe 250,000 plus jobs added last month in the U.S. economy. Over 200,000 of those were in the service sector.
Got it. So as long as services, which becoming a bigger piece of the economy, right?
Exactly.
As long as those stay strong, then you're not going to have big unemployment numbers.
Exactly. So you're not going to really see like a big slow down in the pace of hiring until things start slowing down on the service side of things. And as long as that stays strong, hiring will be strong. The sort of the goods hiring in manufacturing and construction, that's sort of the icing on the cake that can turn like a good number into a really strong number. So, like I said, last month was over 250,000 jobs added, 200,000 in the service sector, another 35,000 in construction, and then you get this big number.
It strikes me though, if you're an asset-based carrier or you're in freight, that actually there's a negative side to that. Good for employment, but then you're competing against other sectors of the economy, like warehousing and construction potentially, that services overall that make it harder to hire and retain drivers.
No, absolutely.
So you're having to pay up.
It's a big problem. It's a problem all across the economy now, where several sectors are just reporting that they have a hard time finding workers, and turnover's high because the unemployment rate is low, and firms are willing to pay more.
So carriers, to solve their driver shortage, shortage of people not driving their trucks, are going to have to increase driver salaries at a time when they don't have pricing power.
Absolutely.
This is
Okay, and so this is retail activity. I mean, again, like a lot of things in the economy, retail activity is downshifted since last year. I mean, last year was a very strong year for retail, especially the middle parts of last year where growth was over 6% year over year. It's definitely come down from that, but it hasn't collapsed. In fact, there was some concern in December, January, and February that retail was really going to take a nosedive.
Is that a really weird number? Was that just government shutdown?
Yeah, I really don't know what happened there. The good news is that it doesn't really matter to me anymore because I don't plan December year over year comparisons anymore. But yeah, like it was a temporary thing. Things are kind of back at this like 3% growth rate. And within retail, e-commerce continues to be one of the standout areas. Like overall retail, there was a really suspicious drop in e-commerce activity in December, but it's right back at this like double-digit pace of growth year over year. I don't expect that's going to change anytime soon. And again, as long as hiring stays strong, I think the retail sector still looks pretty good. On the housing side, housing was one of the real areas of weakness in 2018. Like while most of the rest of the economy was humming along, housing struggled quite a bit, especially after the first quarter of last year. But the data has been a little bit more encouraging. We've seen like an uptick in the trend in housing sales over the past couple of months. April's number wasn't great, but I still think that you're on like a general upward trend in terms of the number of houses that people are buying. And this part of this goes back to what's going on with the labor market. As long as job growth is good, mortgage rates are low, income growth is good, you should have a decent amount of demand for housing in the economy. So it also feels like a pretty positive area for overall economic activity.
So we could see, are you saying that a housing bounce back, or at least growth in demand is coming?
Yeah, I mean, in fact, like I think it was derailed a little bit because mortgage rates started coming up at the end of last year. But once like the Fed reversed their stance on things and said like we're not going to raise rates anymore, and there's a chance we may be cutting rates soon, and mortgage rates came back down, I don't see any reason why housing demand doesn't pick back up. Like I don't necessarily think it'll be terribly just growing gangbusters, but I do think positive growth is there. On the trade side, right, this is where a lot of news is being made. I think it's pretty clear that the trade is downshifted quite a bit since the middle part of last year. Now, part of that is tariffs, and in fact, like the easy explanation is just to say like, well, tariffs were implemented in the middle part of last year, and then after that, trade trade really took a nosedive in terms of both exports and imports. But I think the bigger problem is actually global growth. You know, I've said for a while now that like when you actually look at what tariffs do to import and export volumes, how it affects the cost of these things, it's not enough to make these things collapse. But what is enough to make export and import growth die down significantly is the fact that like Europe isn't doing well and the Chinese economy is slowing down. And like all these major export markets that the US has, they're slowing down considerably. That reduces the demand for US exports. I think that's the big problem that's causing this big decline. And tariffs just make a bad situation worse in that regard.
And probably also just disruption of supply chains, the defensibility of those executives makes them, you know, everybody just reacts to it.
Sure. And you're seeing similar sorts of things in survey data. This is ISM data, right? So remember that this is survey data where they're asking whether or not activity is expanding or contracting. And then anything over 50 means that more than half of the respondents are saying activity is expanding. Right, so here I have manufacturing export orders, and I have the orange line is the manufacturing imports. Right? And both of those have died down significantly.
So below 50,
they're
so
now
we have
below
some
50.
contraction.
Right, exactly. And in fact, in the previous slide, there were updated numbers released about like a couple hours ago. Export growth is negative year over year now, and goods import growth is slightly negative year over year. So trade is a real area of concern for the U.S. economy. Which brings me to what's been going on with tariffs. Right, it's kind of funny because like the last time we got together, I think the general consensus was that a deal with China was right around the corner. Like when you listen to the trade officials coming out of the Trump administration, they were like, well, we're working on like the final details. And, you know, as soon as we figure out how to enforce these things properly, we'll have a deal and there won't be any tariffs. And so as a result, I kind of felt like things were about to pick up. And then there was just like a complete reversal.
It was sudden. It was like a week. Or like you got 1 week.
Exactly. It was. They didn't give a whole lot of warning. They didn't give a whole lot of time between when they changed the policy and when the policies went into effect. And it's changed the outlook. I think quite a bit. Like my general position on a lot of this early weakness is that I've chalked a bunch of it up to just temporary sorts of things. Like there was poor weather. There was inventory. There was imports that were pulled ahead. A lot of sort of temporary things that were occurring during the first quarter of the year. And then the expectation would be like once you get past those temporary factors, you get like a pickup in activity, because I didn't think anything fundamentally was wrong with it. Now, if you reintroduce this idea that like, you know, now we're going to re-escalate a trade war, you have to wonder whether or not there's ever going to be like this pickup in activity. Like things didn't perform well during the first quarter. How big of a reacceleration can you expect to see? And this is especially true on the trade and the manufacturing side. When you're talking about manufacturing activity, you know, do you get like a rebound in manufacturing activity if you're constantly under this trade uncertainty or escalating trade measures on both sides here? And so where we are right now is that the U.S. ramped up their tariffs on the goods that they were already instituting tariffs on from 10% to 25%. And there's threats to broaden it to include everything that comes in from China. And then the Chinese responded by implementing some tariffs on goods coming out of the U.S. going into China already. I would say that like when thinking about the effects of these tariffs, it's going to be a tougher slog in 2019 than it was in 2018. Like businesses, for one, the targeted areas in 2018 were a lot of like intermediate goods. They usually, these kind of goods usually have higher margins. Companies were able to kind of absorb the impact of the tariffs in their margins. And the other thing is 2018 saw like a significant appreciation of the US dollar. And so that offset a lot of the impact the tariffs would have had. So if you think about like what a 10% tariff does, you have a 10% tariff, but the value of the dollar rises 8% during that same time period. Doesn't mean a whole lot.
2% tax.
Exactly. Like it's a small tax that comes along with it. But the dollar, I don't think, has another 8% kind of growth or 10% growth.
Or 25%.
Exactly. Like that kind of acceleration in the value of the dollar I don't think is in the cards. And so you're not going to get that. And you also don't have like the benefit of a tax cut that was passed in 2018 that might have given you some room to play with in your margins this year.
So,
right?
So I guess to understand, there are no tailwinds that are going to bring that surge of activity. I mean, government spending is already at a record high. So,
well, I just think it'll be tougher for these companies to absorb the increase from 10 to 25% this year as opposed to last year. And if you broaden it and include everything that comes into China, you're now starting to talk about these consumer goods that end up in.
And we're going to hear more. Henry Byers is going to be shortly. He's going to talk a little bit about trade.
Yeah. So the direct effects, tariffs make trade more expensive. They reduce imports, right? And I would say that in the near term, you can expect some trade volatility. I know last year when tariffs were announced, there was sort of a rush to get things in and out of these countries before tariffs were put into effect. And so you can expect, I still expect some kind of volatility associated to that. Over the long term, the net effect, the direct effect of tariffs is to reduce trade. Businesses will start to adjust. They'll rethink their supply chains and things like that. You have to worry about the impact on consumer prices. What I'm much more concerned about are these spillover effects, like not necessarily what happens to trade, but what happens to consumer confidence, what happens to business confidence, what happens to investment plans by businesses. Right, this is what takes like something that affects a fairly small area of the economy. Like international trade makes up about 15% of economic activity, but it broadens it to include a lot of other areas.
And how much of freight is really related to trade?
So how much of
freight, just overall freight, if you netted that out? You said it's 15% of the economy, but it has an outsized a part of freight.
Exactly. So I'd say it's about 30 to 35%.
Okay.
It's a little tricky to disentangle the trade numbers from the manufacturing numbers that come out, but I would say somewhere around that. And so just to reinforce this idea of like these spillover effects, like what I have here is factory orders. This is orders from manufacturers, and orders from manufacturers were on a very strong upward trend all throughout 2017, throughout the early parts of 2018. Then tariffs were implemented, and they basically flatlined, right? And so then there's other things going on at the same time, but I think tariffs are playing part of a role here. That like once these tariffs were implemented, a lot of businesses stepped back and said, well, maybe we won't buy that equipment, or maybe we won't expand like we were planning to expand. You sort of see this stalling. Now, the one thing I don't know is like whether or not this new range of tariffs starts to turn that negative or just keeps it flat. If it keeps it flat, I think you probably avoid like a prolonged rate kind of recession. But if it turns negative, it becomes one of those things that signals a significant recession. So just quickly on the capacity side, this is trucking hires. The one thing I wanted to note here is just that trucking hires declined for the first time in about a year in April, right? And so they had a year in 2018 where they added about 45,000 workers to payrolls within the industry. And since then, it's kind of stalled out.
It coincides with a friend of mine that has a large trucking insurance company. He said in April was the first time they saw trucks that were actually, the policy renewals were less trucks than they were adding less trucks. They were taking trucks off their policies. It's the first time they'd seen that.
Yeah, and I've always said that like hiring follows activity. So as that freight activity dies down, I think the conditions suggest that you probably see more downward movements in payroll than upward. This is just truck orders, just showing the surge that occurred.
I think you and I have the same slide.
I'll let you cover it.
Yeah, we'll get to it in a second.
And so what all of this means is just downward pressure on freight rates, right?
So capacity's up.
Capacity's up. Demand's down.
Yeah.
And it's pushing rates down. And I think there's probably further to fall.
And this is government data. This is based on government general cost data. Yes. So let's get into the freight market update. We just have a few minutes to dive into it before we wrap up. But a couple of things to keep in mind. It looks like our numbers got left out. But a couple of things that I wanted to talk about was actually diving into it's important to know which parts of the economy drive freight in order to really diagnose this stuff. So you had mentioned services, obviously. Healthcare is not driving much freight. Education, things like that aren't driving freight. But the stuff that is driving freight, it's important to actually look at those sectors. And this is based on government data related to total ton miles, and it's across all modes. Energy being the largest, obviously coal is a big piece of that, really related to the railroads. But rail and truck have a lot to do with one another and are impacted by one another. Agriculture is a big piece of freight. 25% of the freight market's agriculture. It's big in exports. And this is actually, the tariffs that China has put on actually are impacting things like soy farm and stuff like that. So that's hard to, and weather is also significantly impacting freight demand and freight flows. You get into other things. We mentioned construction. A lot of that's housing construction that really drives freight and so forth. But it's important to look at those to really get into the freight market. One of the things, and this is probably the one that I would say, for me, we had talked about whether we were in a freight recession. You know, I've had discussions, or whether we're headed into a freight recession. This is the one that really caught me off guard. Was this? We have an index called the Outbound Tender Volume Index, which is really a reflection of the total amount of transactions in the market. Tenders are contracted loads. It had a significant and sizable drop off in mid-May. And regardless, one of the arguments people have had about you can't compare 2019 to 2018 because 18 was such a big year. My response to that is you're correct, but let's go look at where we started in April at the start of the quarter and look at whether there was a typical season pattern or it was down. And what we have seen is actually that volumes are actually dropping and did drop significantly in the month of May, which is really, for me, a warning sign, because if you have higher capacity, 5%, at a time when volumes are really decelerating, that's a pretty concerning thing. So it's going to see something we watch. One of the other things, and of course this is something that gets discussed. One thing I wanted to make clear, because there's been some confusion about the DAT Van Freight Rate Index that we published. The data comes from DAT in addition to the national index. They're actually labeled quite similarly, but what this particular index does is track long haul, over the road spot long haul rates. Their national trend lines is really a basket of the entire market, which is more skewed towards tweener and other types of short haul freight. This one actually tracks the long haul market, and because it's specific lanes, and you can do year-over-year comparisons on those lanes, I think it's highly relevant for what's happening. But we're actually seeing that for the first time this year, that freight rate, those long haul rates are actually dropping below where they were in 2017. Now, this is the part people say, well, that's not so bad. I would disagree. The reason I disagree is back then oil prices were in the $30 a barrel. You didn't have the 20% pay increases for drivers. You didn't have, interest rates were lower. So you had all these sort of cyclical advantages and cost advantages back in those days. Today, you don't have those. You have low rates and low volume, which is actually quite concerning. We'll see where it goes. It looks like it's sort of flattened out. I'm not seeing downward pressure on those rates. And maybe that's a good sign. Maybe that's a sign that there is enough to hold up price, or maybe it's a sign on these particular segments of the market that carriers are just saying, I'm not going to haul any cheaper than that. I've hit my rock bottom, and I'm just not going to take a load at a price cheaper than that.
Now, how much of that do you think has to do with produce season?
Yeah, it's interesting. So produce is certainly a big impact. I mean, the reason I don't think you can look at spot rates alone and sort of drive every conclusion you want is you have to look at these in combination. So when spot rates have been on the downfall all year, and really since it peaked last year. But the part that really got me was the tender volume index, and the reason that's interesting is it doesn't really have a ton of spot activity. And a lot of produce is actually, a lot of that's actually through the spot market. It's handled through transactions because it's very seasonal and cyclical, and it moves through these different cycles in different regions. And so what I think is interesting about that is it looks like the broader part of the freight market actually slowed down. Spot rates are low, but have been trending low. And certainly weather has had a huge impact on freight demand and freight rates. Looking in terms of just capacity, the OTRI, the Outbound Tender Reject Index, which is really a function of whether there is capacity available for dispatch or accept loads, and whether carriers are turning them down, that's just at a low. It's almost at a level that just it can't get lower. Maybe I'll be saying in a year from now, maybe I won't be saying that, but at 4.34%, that's just slop in the system. I mean, it's almost a rounding error at this point.
There's definitely like there's a lower bound here.
Yeah.
Get any lower.
Well, that's true. So, I mean, if this was sort of scaled, maybe that would look like a high number in a year. I don't know, but right now we're seeing it sort of flatten out, and as we sort of see rates come down, that's something to certainly watch. Moving into just specific. So one of the things that gets discussed a lot, and we've discussed that on the last call, I'll discuss it again today, is that the ports have actually been driving a ton of the domestic freight activity as it relates to pre-staging of freight. That dropped off. Actually, in May, we saw the volumes drop off at major ports. LA being, of course, the biggest market for ports and the biggest ports in the U.S., and certainly the one that's most exposed to Asian imports, had a very significant drop off. And so that tells me that a lot of what was driving that freight demand last year was, if you saw the growth of LA's volume, a lot of the additional surplus in volume is actually driven by that. And you can actually see that in that trucks, if you look at the truck data, and I think it's in one of these slides, it actually shows that trucks have also migrated out to the West Coast to take advantage of that freight. One of the things that's also to watch is this Class 8 truck production. I did talk to an OEM earlier today that had told me that they still have a back order, they still have a backlog. Although it was over 100,000, now it's around 20,000. They're working through that backlog of getting new trucks out, but they're certainly seeing people not take order or cancel those pre-buys or pre-orders that they had made, and the book is starting to thin out. We'll see if they ever end up in a situation where there aren't pre-purchases and what the lead time is. That will be telling. This is the slide I was talking about, this trucks in market. You can see that LA has actually grown in terms of capacity by 31% since last year, since April 1st, 2018, while cities like Chicago have not. Chicago has not seen additional surplus capacity. It's basically been flat. A couple things from our friends at Convoy, talking just about general capacity. Reefers, this is a good time. The Southeast has not had the significant weather of the Midwest. Therefore, capacity, if you run a refrigerated fleet in the Southeast, you're doing quite well compared to some of it. It's interesting because I look at this chart and I compare it to the last call. It's a lot less green today than there was last time. So maybe that's an encouraging sign. Ibrahiim, maybe I'm wrong about this decline, and I hope that I am. I certainly want all of that to be super red. So.
I would say it's kind of 50-50 right now.
We're gonna flip a coin.
So it's kind of what I do.
I don't know that a PhD in trained economist should admit that. So, but also one of the things that is also interesting to watch, and I actually think this is something that is relatively new with ELDs and digital brokerage apps, we can actually get access to this data, is wait times. And we're seeing that in a sloppy market with a lot of capacity and maybe just a lower volume and velocity of freight, is that wait times actually increase. And so at a time where drivers are not making as much money because there's not as much demand, they're also waiting at facilities longer. Where you have a tighter market for capacity, drivers are waiting, have shorter wait times. We saw wait times go up. It's a discouraging sign. I think the idea, it was an interesting comment and quote, is that the concept of shipper of choice isn't as important as it was a year. Now it's carrier of choice. That's right. It's provider of choice. We have flipped it, so who knows? One of the things to look at also is rail and truck freight have a lot to do with one another. If you look at intermodal freight, intermodal freight is down. But one of the things that's really interesting to watch is actually the total amount that comes from intermodal and TOFC, or trailer on flat car versus container. And so the TOFC business traffic has actually dropped significantly, while the container boxes have not had that significant drop. And of course, the correlation of spot rates and orders, which we've really talked about truck orders quite a bit. Diesel is still high, and this is a concerning sign for those small operators. They're paying retail diesel prices at a time when freight rates are lower. That is something to watch. In the past, there's been a high correlation of truck bankruptcies to high diesel prices. And so you can look at the data that supports that. We did not, the nice thing in 15, 16, we had low oil prices, which kept a lot of these guys afloat during the down cycle. This time, they're not benefiting from that. And then, of course, another warning sign is air freight. So we're seeing slowdown in almost every mode of traffic. Air freight is down 4.7% year over year. One of the things to highlight is, and which is obvious, is that Asian air cargo volume is down significantly, probably just related to, as you said, the global economy and trade is impacting it. So looking at just in terms of container volumes. Buyers, welcome. Do you want to go ahead and take that? Do you want to dive into that?
Yeah, sure, absolutely. This is the FreightWaves Baltic Daily Index. It's representative of 40-foot containers in the spot market. Really, with the interesting point here is that they were 56% higher to the West Coast, and those dropped significantly here in the last couple of weeks. It's actually down closer to really right around 15% higher than last year.
So they're still higher.
Still higher,
but that peak that we saw in the first quarter has dropped, right? I guess it's fourth quarter you saw the peak.
Yes, and what was also interesting is the East Coast rates jumped just a little bit there in May 15th, and that was mainly due to the capacity crunch due to the Panama Canal.
Okay.
There was a drought there. The ocean carriers really love a chance to kind of create some chaos.
So I got a question. That drop off that we saw mid-month, I guess LA dropped off significantly. So you don't think it has anything to do with the Panama Canal, do you?
Well, no, not necessarily in terms of, ocean container volumes. But on the West Coast, I think, all the tariff pull forward, all that demand, I think you're totally right in saying that, that was kind of finally getting out of the warehouses, getting pushed off in terms of the truckload market.
So we had sort of absorbed all that demand that was sitting in warehouses, and now there's not enough stuff being shipped, right?
Sure. Yeah. And, obviously overcapacity hasn't really helped things in the truckload market, but, this is typically during this time of the year, volumes are down. In containers. So, from my standpoint on the ocean containerized freight, fairly normal right now.
So you saw the drop that you saw was not surprising to you in terms of seasonality.
Well, on the truckload volumes, it was surprising how far it dropped.
Yeah. But also this is atypical in truck. But I'm talking specifically the container volumes. Okay. A normal cycle this time of year, it would be softer than the rate.
Yes, absolutely. And rates would normally reflect that.
And it may be that once those tariffs went into effect, once there was sort of pressure on that volume that was driving the domestic market just wasn't there, and we were going to a more typical seasonal pattern, which is why we have this sort of lull in business, right?
Sure.
So, well, interesting.
This is a graphic that I had composed. Everybody's really kind of questioning in the truckload market, where's the volume? Where's it coming from? Is there anything on the ocean? And I think this is the best representation of what's happening here in May in the ocean containerized freight. I'm looking at year over year, increases and decreases in the top 10 U.S. ports, and based on a per day pace. So we really only have about through the May 24th of data at this point. But using the average TEUs per day in May, went ahead and calculated that out through 31 days.
What is, LA, Long Beach is not a huge surprise. What is Tacoma doing?
Well, the ocean carriers were really pushing the Pacific Northwest this year. Okay. A lot of that had to do with congestion in the ports, with all the tariff pull forward really causing quite a bit of chaos.
So they were saying, hey, there's capacity in Tacoma, go up there. Yep. Go north.
And those ports outside of LA, like Savannah's done a great job. They're really all competing with LA and Long Beach because it's just been, with Trans-Pacific being such a large trade lane, it's really how do we increase our efficiency, our throughput in order to take market share from those guys. And, Tacoma's really done a great job at that.
That's an interesting slide. What do we have here?
Yeah, so I really wanted to show, of all the countries of origin for U.S. imports, China obviously being the largest and having the most market share of those containerized imports. I wanted to look at year over year. So January 1st to May 20th, 2019 versus 2018. And I wanted to show that in basis points because I think that's the best way to show, where the volume has decreased and where has it increased in terms of where are those, factors of production moving. If they're not, if they are moving from China, where are they going to? Who's kind of picking up that slack? And Vietnam has been a big winner.
So Vietnam is a winner, while China has been the big loser. Right?
Well, it's certainly lost some. Yeah, I think the trade worries, the trade concerns definitely forced a lot of U.S. importers to look elsewhere.
Is that ever returnable? I mean, it seems to me that if you've had to spend the money and expense to diversify your supply chain, you're probably not returning back to mainland China.
I think just
because of the geopolitical risks are so high.
Exactly. I think that we're at a point now where the average wages in China have increased. The middle class is Somebody said over the last 10 years, 68% of the population has gone to around poverty line to middle class. So wages rising like that, it's just kind of forced those U.S. importers to look elsewhere.
Yeah, it's great stuff. And we'll welcome and really appreciate you coming on. Maybe we'll have you each time. It's good to get the international update.
Yeah, for sure.
So summary, the freight economy has struggled thus far this year, and recent tariffs are casting doubt on the strength of the economy. Trucking employment fell for the first time since July 2018, and increased capacity will likely lead to downward pressure, even if volume growth were to improve. So we'll see, right?
Yeah, I mean, like I said earlier, I think it's pretty much, I think most people would agree that the freight economy has been soft so far this year. My only question is whether or not it's a temporary thing and it comes back, or it's something that's like a prolonged.
What is your knowledge? I know you're an economist, and you won't call it in this. You have data, but where do you think?
If the tariffs stay in place, I think it probably just turns down.
It just continues to decelerate.
Yeah.
So okay.
But
if the tariffs were to be removed, do you think that changes?
Yes.
Okay.
Yes.
So you actually think tariffs?
Exactly. And in fact, I think most of the theme last time we got together was how there were better freight days ahead because we were pretty close to
get it together. Let's do this.
But yeah, I mean, and especially if tariffs get expanded to include everything coming from China, then I think the freight economy is going to have a real tough slog in 2019.
Yeah.
And I mean, again, I think just because of how fast capacity increased last year.
I've had this conversation. I think the super surge in last year did more damage this year. Had it not been so violent and surge up, that if we had a gradual increase, I think we'd be in a healthier market today than we were last year.
I mean, you wouldn't see the same kind of run up in capacity, I think.
No, right? And the problem is everybody who thought they could be a truck owner or trucking company got to become a trucking company last year.
Exactly.
So I think, we really appreciate you coming. We've got some Q&A ahead. I want to remind everybody that we do take questions at the end of this conversation, and we'll dive into those questions here shortly. Come check us out we've just changed the name. FreightWaves Live, MarketWaves 19 in Chicago, November 12th and 13th is now called FreightWaves Live. It's to basically to extend the FreightWaves brand related to the events to both events. And of course, we'll be there talking and diving into technology and diving into our demos. So now, unfortunately, Marianne is not here. So Barry, do we have questions? We do have a question. Okay, I can't read that from where I'm sitting. Henry, do you want to be the reader?
Sure. It says, what are your projections for air freight? Will it remain soft throughout the calendar year?
Henry, you're the international guy. What do you think?
Well, it's interesting. I think air freight, if you look at the seasonality, especially from, Southeast Asia to the U.S., it is kind of a downtime, historically through May, June, even some of July. But I would definitely expect it to pick up moving into peak season. Because a lot of these retailers have still got to bring a lot of this product in regardless of the tariffs. And a lot of that stuff's higher value goods.
Yeah, particularly electronics. The other part of air freight, domestic air freight particularly, is auto related. Mm-hmm. And that domestic air freight may be down because particularly that the next flight out stuff and the JIT stuff is impacted. So,
sure.
Parcel e-commerce is just going to grow, right? I mean, that's just, but a lot of that moves by truck, so it doesn't even move by airplanes.
I mean, e-commerce has been like the most consistent source of strength in the economy since the recession.
And now we're on 7-day. FedEx just announced today 7-day delivery. Is UPS 7 day?
If they're not,
it's going to be tomorrow. We'll see a press release. What else we got, Henry?
It says, are we starting to see capacity leave the market, or is capacity just being added more slowly?
No, I think we're actually seeing some capacity leave the market. I mean, I'm hearing stories. I think the most telling sign of that is really related to new truck orders that dropped off, and the other thing is talking to the truck stops. We're seeing less gallons pumped. Are people pumping less gallons? And then the other thing is really talking to an insurance company that does underwriting truck insurance. They said for the first time they're actually seeing less trucks being renewed. Same policies or same policyholders renewing, just less number of trucks on their fleet, which suggests that we might see some churn out. I mean, frankly, and I know this is a really unpopular statement, is a strong downturn. If we get a V-shaped dip where you have a real strong downturn, but enough to sort of get rid of some of the weaker players in the market, we might come out of that much healthier at the end of it than where we're at right now. There's just too much capacity out there. A lot of folks that just aren't sophisticated enough to be in a market where it isn't great.
Normally, when I look at capacity, I try to pay attention to the driver number,
Employment.
the employment figures. Keep in mind that like the trucking employment numbers, that's not a pure driver's number. Like there's a whole swath of independents that the BLS misses.
I
think they're going to be the ones that leave first.
I like the diesel gallon. I mean, to me, the truck stops, the ones that whether it's private fleet, public fleet, or for hire fleet, they're the ones that see the most activity in diesel gallons of all of them. So,
next one. What are your thoughts around the reefer LTL market, and where's it heading?
Reefer LTL, that's a good question. Well, I think in general, reefer refrigerated freight, or I should say, so refrigerated freight's really tied a lot into produce, and so obviously the weather has had an outsized impact on the heartland and economy, and exports have had a big issue. So there's certainly going to be some capacity. The other thing to watch in the LTL markets is LTL runs in slightly different cycles than truckload, because when the truckload market slows down, actually LTL tends to stay pretty strong. And the reason for that is that shippers just are moving less truckload and still, they're still in business, so they're still moving freight. They just tend to move into smaller shipment sizes. So I think LTL looks to be a pretty strong. I'm not negative on the LTL market right now. What we're looking at as it relates to freight is really related to the truckload market. I think LTL is, at least right now, is somewhat insulated from some of the downturn in the truckload market. And frankly, their purchase transportation cost should be lighter pressure on PT in this environment because they're not having to fight as hard for capacity.
The next one looks like it's addressed to me. What are your projections for ocean freight from China? Would long-term fixed rates be a good option this year, and what do you think? In my opinion, it's one of those things that they were signed pretty low this year. It was really about $100 to $200 higher than last year. I think it would be a good option if you have the volume, because with how the carriers are looking at it now is in terms of per weekly allocation. You got to make sure your space is available once peak season comes around, because you don't want to get left behind. But one thing to watch, obviously, the volatility. If suppliers continue to move out of China, you could see those go down. And then the last one is, will Uber Freight become a valid competitor? Would that increase the number of trucks employed?
That's an interesting question. Are they a valid competitor is the question? Yeah. Somebody a little cynical about Uber's whether they're a valid competitor. I would say they're a valid. I don't know what the word valid means. They're a competitor, right? They're certainly, I think in some ways the digital freight industry, if you classify as the digital freight guys, in some ways put a lot of pressure on traditional business models, because they operate with a slightly different set of market instincts and technology than the traditional players do. And so in terms of how they operate, I think you have to consider them a very viable competitor. And in many ways, they're going to be a huge beneficiary of this cycle, because they're the very firms, and I'm talking broadly about all the digital guys broadly defined, they're the very firms that are willing to do things that some of the other ones can't or won't do. And so I think in many ways, they will become healthier or stronger in a down cycle. And I think also there's going to be, and this is just broadly defined as all freight brokers, I think there's going to be a flight to quality. I think a lot of the small, and this is true of the asset side or non-asset side, a lot of companies that are considered less quality players are going to get washed out. And that's true of the freight brokerage industry. And if I'm a carrier, if I were a driver, if I had a couple of trucks or even a lot of trucks, and I'm trying to find freight, I'm going to call up the people who have freight that I most recognize to have freight. That's going to be the high momentum guys, Convoy, and you mentioned Uber, JB Hunt, 360, and players like that. It's also going to be a lot of the large established names like a Coyote and C.H. Robinson. So I think there's going to be a flight to quality among the carrier base, and it's going to give them a bit of advantage. And certainly, I think that what comes out of this cycle will be strong. The digital guys actually have a chance to gain a ton of market share because they're willing to do things that bring more value and be a bit more experimental, their business models, than perhaps some of the other ones that are just trying to fight for survival. So I want to thank everybody for coming to this particular episode. Buyers, Henry Buyers, welcome to your first. And Ibrahiim, it's good to see you again. We will have this recorded and downloadable very soon. And want to thank everybody for coming. And also want to thank our friends at Convoy for hosting and helping co-host this webinar. And we look forward to catching up next month. Thank you.